Welcome to this video on a study of option time value. First, a quick reminder of what time value is. Time value is the portion of the option premium that is not intrinsic value. And intrinsic value is the amount by which the option is in the money, which is a way of saying that if the stock price remained unchanged through to expiration, only the intrinsic value would remain. So for example, if a $50 call option has a premium of $5 when the market price is $51, then it has $4 of time value and $1 of intrinsic value. And if the price stayed $51, the option would be worth $1 and the time value would be lost at the end. And at any time, the premium can be a mix of time and intrinsic value or pure time value if it's out of the money and has no intrinsic value. So what influences time value? Let's look at some time value factors. First, time to expiration. In general, the longer the time to expiration, the higher the time value will be. Next, closeness of market price to strike price. The closer the two prices are, the higher the time value will be. And the last one would be the volatility of the underlying stock. The more volatile the underlying stock, the higher the time value will be. So let's look at each of these in more detail. A word about option chains. The values we'll be using to demonstrate these concepts of time value will be coming from option chains for the different stocks. An option chain is the list of expirations available and the different strikes with their premiums that are trading for each expiration. In a previous video, I've said that most of these expirations happen on Friday, and we'll see these here. This is an example of an option chain. On this page, we can see the name of the stock, Microsoft, and its price at the time, $410. We then see a list of expiration dates, and for some of them, a list of strike prices that are available. The W in parentheses after some of the dates marks them as a weekly expiration. The ones without are referred to as standard monthly options and are the third Friday of the month. At any given time, only certain expiration dates are available. There are more in the short term and fewer in the long term. This page shows calls on the left and puts on the right. For each strike price offered, the bid and ask premiums are shown. And this is an important tool when choosing the expiration and strike that you want to trade. Okay, so now time to expiration. The closer we are to expiration, the lower the time value of the option. It's just the opposite of what we were saying before. As it's further out, it's higher, and as we get closer, it decreases. And actually, at expiration, the time value is 0. That's an important concept. As we go out in time, time value will increase to reflect the uncertainty of where the stock price will end up. And we'll see the change is not a linear one. This graph shows time value versus days to expiration. So short-term options are on the left and longer-term options are on the right. We can see that the premium increases as the time to expiration increases, but the change is not the same between each expiration. There's usually a much bigger change near expiration and smaller changes far from expiration. This means that when we buy an option, we pay time value, and that time value decreases over time until it reaches 0 at expiration. And this is referred to as time decay. And you can use this knowledge to your advantage. When buying, you want to minimize the amount of time value that you pay. The more time value paid, the more in the money the option has to be to actually make a profit. And when selling, you want to maximize the amount of time value that you receive. Now let's check out closeness of the market price to the strike price. For the same expiration, the closer the strike price is to the market price, the higher the time value will be. And this is true on either side of the strike price. The one that makes us out of the money and the one that makes us in the money. And this tells us that the highest time value is when the strike price and the market price are the same. This graph tracks the premiums of Apple put options over a range of strikes. It starts out with out-of-the-money lower strikes and moves through the current market price, indicated with the vertical dashed line, through to more in-the-money strike prices. The red line shows the portion of the premium that is intrinsic value. Note that for out-of-the-money strikes, this is 0. As soon as the option is in the money, which for a put is when the strike price is above the market price, the intrinsic value tracks the difference between the two prices. The green line shows the time value component of the premium. We can see that it is the entire premium when out of the money, and then is a smaller and smaller portion of the premium when in the money. This holds true for call options as well, except that the sides will of course be reversed. It will be in the money on the other side. Volatility. Volatility is a measure of how much the stock price changes more in a short period of time than gradually over a long period of time. If a stock price never changed, it would have 0 volatility. And the more a stock price changes, the higher the volatility of that stock. Again, the more it changes, if it goes up and down a lot every day, that would make it a higher volatility stock. And the higher the volatility, the higher the time value of that option. All other things equal, the option for the stock with the higher volatility will have a higher time value. So why would that be? That would be because if the price changes a lot, then we have a higher chance that at expiration, the stock will have moved in the direction that will make that option be in the money. And it will give you a better chance of attaining your goal and making a profit. So the person selling that is going to ask for more money to cover that risk. So thanks for listening.